Happy Monday, everybody. I hope you had a great weekend. Today is March 28th, 2022, and this is your Monday Market Update. Thanks for tuning into this 5 to 7 minutes of important information on past week's market action and what we can expect from this coming week. I remind you quickly that this is the In the Weeds market action news. We will continue to focus on the long term and your short and long term goals. Tune in on Friday for those planning videos, and also please call or email if we have not yet spoken about your 2022 goals. This year will certainly be a different year than the past few. Quick reminder of the headwinds this market. The Fed's raising interest rates and shrinking their balance sheet. That works out to two different attacks on rates. Growth is still slowing. Will it roll over? We have the Russia-Ukraine war, of course. Supply chain problems persist. Oil prices lead the pack on higher prices, and we're facing the highest inflation rates in 40 years. This does not mean that we won't see positive returns in the markets in 2022. It means that the headwinds are there and the environment is different. We still do have lots of good news, providing tailwinds to the markets. What is that? Geopolitics will hopefully resolve itself at some point. The jobless numbers are small and the job opening numbers are large. The demand for products and services are still booming. I've told you that we're watching for all the switches to be in the on position. We still have some coming. Travel is coming back. Air, rail, even water. International travel will eventually come back. It's coming back soon. Companies also have spent the past 2 years becoming leaner and more productive. There will also be some peak inflation news at some point. We've seen the green shoots of that, sort of like the green shoots here in Chicago this month. They'll be hit with another freeze before they get it all clear. But so next month we will see worse inflation numbers because the data from the war is going to be coming through, oil and other price hikes. We'll see some price inflation news, some peak inflation news return at some point. As I mentioned, two headlines to watch for: peak inflation and ceasefire. Those will put the market risk on, at least for the day that we see that, for at least maybe for a few minutes that we see that. That's the lay of the land. Let's wrap last week, and then we'll preview the coming week. Last week, Monday started on a strong leg with upside momentum from the prior week, along with ceasefire hopes. Cold water was poured on that by Bostic from the Atlanta Fed early, but then the whole water cooler was poured on when Powell spoke. He took a very hawkish tone, basically said the same thing he's been saying, but said it with a tone that was not appreciated by the market. 50 basis points is back on the table, and basically everything goes for Fed policy coming up. They will attack this inflation, and the intention is to catch up. My words, not his. He did maintain that the economy is strong and can handle this, but we'll just have to see. Regardless, the market did not like to think about that on a Monday morning. So a little air was let out of the markets. S&P closed nearly flat with some late buying. Dow and NASDAQ both down about 0.5%. The 10-year was at 2.38% and oil was at 112.60. Finally, the 210s was below 20 basis point. Only a matter of time before we see the inversion, and then the clock starts. We'll cover more of that soon. Tuesday found the market following the momentum as news flow was light. Bond yields moved up again. The 10-year yield closed at 238. 2s10s opened up a little bit to 22. Energy was the only sector down, and just on some profit taking. As the oil trade bounces around, it's odd that the moves in the yield that used to crush the growth trade actually were supportive. The S&P 500 was up 1.13%, Dow 0.7%, and the NASDAQ up 1.9%. Again, weird with rates so high. Looks like it might be an oversold bounce, but we're not sure. We'll see how long it'll last. As I mentioned, news was light on the Fed and Russia, and the two biggest drivers of the market, so the market roamed higher. The recent rally stalled on Wednesday with all kinds of fears. Nothing new. Geopolitics, stagflation, add in some rebalancing as the end of the quarter approaches. The S&P 500 was down about 0.25% and turned negative for the week. Dow and NASDAQ also down about the same on the day. We did get some inflation news from the UK, the highest in 30 years. More hawkish comments from the members of the Fed, voting members this time. Oil was higher by over 5% on the day. Keep an eye on that. Maybe an interesting reverse correlation. Oil up, market down. Commodities are in the spotlight. Someone even called them the new FANG. That's fuel, architecture, natural resources, and gold. FANG. Back to the other side of the boat. On Thursday, stocks opened to the green. As I mentioned, oil was down. Stocks were up. Jobless numbers were the lowest since 1969. Heard an interesting note yesterday that as companies lobby to get tax breaks in certain areas to open a new plant or something like that, they often note how many jobs they'll create. With 11 million jobs open and the lowest jobless rate since 1969, is that compelling argument anymore? Don't think so. What fueled a recent yo-yo move, aside from the fact that the day before was down? So now it was up. Positive economic numbers and the feeling of progress towards a solution with the Russia-Ukraine war. I don't know. There's no middle on this one. Either research I read says peace is going to come, no doubt, or war is going to go on, going to get worse, no doubt. That, of course, means plenty of doubt, as no one really has a good idea of what's going to happen. Thursday, a headline was quoted that negotiators said that careful optimism, Last time I heard that, it was denied by Moscow, so we'll see what happens. We had a few more speakers. Remember, I told you last week over a dozen of them spoke this past week. Pretty much the same tune, hawkish, and the market seemed to be pricing in 50 basis points hike in the May meeting, but that's 6 weeks from now. Can the market look past that for a few weeks? President and his trip to Europe, headlines about more pressure in Russia and consequences for nuclear or chemical weapons are used. The market seemed to look at this as progress towards some deal, of course. They have to. As I've told you, I'm not going to impart geopolitics too much here, but I'll ask, if there's not optimism with more pressure on Russia, when will there be? There has to be. The only other option will be NATO forces engaging, or maybe worse, nuclear or chemical attacks. So maybe everyone is on the wishful thinking camp. The S&P 500 closed the day at a 6-week high, up almost 1.5%, Dow up 1%, NASDAQ up 2%. Oil, you guessed it, down 2.25% on the day, reverse correlation. With all of the talk about natural gas, that's the new talk. We'll have to see what comes of that. Prices up big, all the talk about how the U.S. will supply Europe in replacement to the Russian gas. Friday brought an end to the week with a back and forth, but ended up on the upside in the green. There was no negative geopolitical news, and it was a quiet Friday for news in general. Consumer sentiment numbers disappointed. Hawkish Fed comments kept a lid on things. Positioning into the close took the S&P up about 0.5%. Dow was up slightly. NASDAQ spent almost all day in the red and closed just slightly lower for the day. This move and the week, Dow up 0.3%, S&P and NASDAQ up almost 2%, was in the face of the 10-year yield significantly higher, war still raging in Ukraine, oil higher, rate hikes starting, and more on the way, stagflation concern. But what's the alternative to stock? That's the question. So another week, yes, up and down, but not as wild as some of the recent weeks. What are we going to watch for in this coming week? This week, though it seemed to be a quiet week when I first started looking at it, will not be quiet at all. Aside from multiple Fed speakers, all eyes will be on the jobs reports. Wednesday, ADP, Thursday, jobless, and of course the non-farm payroll on Friday. We'll see some other economic growth data. The final Q4 GDP number looking to be around 7%. The real key to the market on this week will be the core PCE price index. Recall, this is the Fed's favorite inflation measure. We currently have a plan for half of the 25 million people in Shanghai to be locked down for the week, and then the other half for the next week. And that will have some ripple effects globally. Even Tesla's plant is going to be shut down in Shanghai. So we know we're going to keep watching the headlines for the face-to-face meetings between Ukraine and Russia, and we'll have to watch the Fed. Both of these remain important, but both also become stale. No one expects surprises from either of these at this point. I guess that's why they call it a surprise, so we'll just have to see. For now, we'll keep working on the long-term plan, remain nimble, add exposure to the market when and where appropriate. Come back on Friday for the planning video, another timely note on some important things to work for 2022. Have a great week.